Intel, or INTC, is one of the most interesting turnaround stories in the semiconductor industry. After years of manufacturing delays, declining competitiveness, and intense pressure from AMD and TSMC, Intel is now attempting one of the biggest transformations in its history. The company is investing heavily in advanced manufacturing, artificial intelligence infrastructure, and its Intel Foundry business. With Intel stock trading around $102 in August 2026, the big question for investors is whether the turnaround can justify an even higher valuation by 2027. Intel recently traded around $102.50 per share, while its 52-week high is around $142. This means the stock has already experienced a major rally, but it remains below its recent peak. The market is increasingly pricing in expectations that Intel can successfully execute its manufacturing roadmap and regain competitiveness. That creates both opportunity and risk, because a successful turnaround could produce significant upside, while another major execution failure could lead to a sharp correction. Intel's biggest opportunity is no longer simply selling traditional PC processors. The company is trying to become a much broader semiconductor platform, with opportunities across data center CPUs, AI infrastructure, advanced packaging, and semiconductor manufacturing. Artificial intelligence is particularly important because the AI boom requires much more than GPUs. AI data centers also require CPUs, networking, memory, power infrastructure, and advanced semiconductor packaging. Intel has an opportunity to participate in several of these markets. Intel's revenue growth is beginning to show signs of improvement. Revenue was approximately $13.6 billion in the first quarter of 2026, representing year-over-year growth of around 7%. More recent results have shown stronger momentum, with second quarter revenue reportedly increasing approximately 25% year-over-year. If this momentum continues, Intel could potentially generate roughly $57 to $59 billion of revenue in 2026 and approximately $62 to $66 billion in 2027. The key question is whether this growth can translate into sustainable profitability. Intel remains an important player in data center CPUs through its Xeon product family. Although NVIDIA dominates AI accelerators, AI data centers still need powerful CPUs to coordinate workloads and manage infrastructure. Intel has also been positioning its Xeon processors within next-generation AI systems. If global AI infrastructure spending continues growing rapidly, Intel could benefit from the CPU portion of this massive investment cycle. However, Intel still faces intense competition from AMD in server CPUs and NVIDIA in accelerated computing. The most important technology development for Intel is its 18A manufacturing process. 18A introduces advanced technologies including Ribbenfett gate all-around transistors and power via backside power delivery. Intel expects 18A to provide meaningful improvements in performance, power efficiency, and transistor density compared with previous manufacturing generations. More importantly, 18A is designed to restore Intel's position as a leading-edge semiconductor manufacturer. If Intel successfully scales 18A, it could become one of the biggest catalysts for the stock. Intel Foundry could eventually become the company's most valuable long-term opportunity. The goal is to manufacture chips not only for Intel, but also for external customers. However, this business is still in an early stage. In the first quarter of 2026, Intel Foundry generated approximately $5.4 billion of revenue, but only around $174 million came from external customers. The business also remained deeply unprofitable. Therefore, investors should focus less on total Foundry revenue and more on whether external customer revenue begins accelerating. Intel has also raised approximately $20 billion through an equity offering. This gives the company additional financial resources to invest in manufacturing and its Foundry strategy. However, there is an important downside: shareholder dilution. When a company issues a large number of new shares, existing shareholders own a smaller percentage of the company. In the short term, that can pressure earnings per share and stock valuation. In the long term, however, the additional capital could be valuable if Intel successfully converts those investments into higher revenue and profitability. Profitability is still one of Intel's biggest challenges. The company is spending heavily on advanced manufacturing while attempting to rebuild its competitive position. My base case estimate puts 2026 earnings per share around $1.50 to $2, followed by approximately $3 to $4.50 in 2027. If Intel executes extremely well, earnings could potentially move toward $5 per share in 2027. But investors should remember that these estimates depend heavily on manufacturing execution, product demand, and margin recovery. Using a conservative discounted cash flow framework, assuming moderate revenue growth, improving operating margins, a discount rate around 9%, and long-term growth around 2.5% to 3%, I estimate Intel's fair value in a broad range. The bear case valuation is approximately $70 to $85. The base case valuation is around $105 to $125, and the bull case valuation could reach approximately $140 to $165. With Intel around $102.50, the stock appears roughly fairly valued under the base case, meaning future upside depends heavily on successful execution. For 2026, my bear case target is approximately $75 to $85. This scenario assumes disappointing manufacturing execution, continued foundry losses, and weaker than expected margins. My base case target is $110 to $125, assuming continued revenue growth and successful 18A production. In a strong bull case, Intel could potentially reach $140 to $155 if AI-related demand remains strong and the market becomes more confident in Intel's manufacturing turnaround. Looking toward 2027, my bear case is approximately $70 to $90. My base case is $130 to $155, assuming Intel successfully improves revenue, earnings, and manufacturing execution. In an aggressive bull case, Intel could potentially reach $170 to $200. That scenario would require a much stronger foundry business, meaningful external customer growth, improving margins, and continued strength in AI infrastructure spending. The bull thesis for Intel is relatively straightforward. If 18A succeeds, Intel can regain credibility in advanced manufacturing. If external foundry customers increase, the company could build a new revenue stream beyond its traditional processor business. At the same time, strong demand for data center CPUs and AI infrastructure could support Intel's product business. If all of these factors occur together, earnings could grow rapidly and investors could assign Intel a higher valuation multiple. Under this scenario, $170 to $200 in 2027 becomes possible. The bear case is that Intel's turnaround takes much longer than expected. If 18A experiences yield or production problems, external customers may hesitate to use Intel Foundry. At the same time, AMD could continue taking CPU market share, while NVIDIA maintains its dominance in AI acceleration. High capital expenditures and foundry losses could also pressure free cash flow. If earnings fail to meet expectations, Intel's current valuation could contract significantly, potentially pushing the stock toward the $70 to $90 range. There are several major risks investors need to watch. The first is execution risk, because Intel has experienced manufacturing and product delays in the past. The second is competition from TSMC, AMD, NVIDIA, and other semiconductor companies. The third is capital intensity, because building advanced fabs requires enormous amounts of money. The fourth is dilution from the recent equity raise. Finally, valuation is another risk. After the stock's significant rally, investors are already expecting a meaningful turnaround, which means disappointing results could trigger a sharp decline. For the next several quarters, investors should focus on three major indicators: 18A production and yield, external Intel Foundry revenue, and free cash flow. These three metrics will tell us whether Intel's turnaround is actually working. Revenue growth alone is not enough. Intel needs to demonstrate that its investments are eventually producing higher margins, stronger cash generation, and sustainable earnings growth. My overall rating for Intel is hold with bullish potential. I would not classify INTC as a low-risk semiconductor investment because the turnaround still depends on several major execution milestones. However, the upside could be significant if Intel successfully executes its 18A roadmap and turns Foundry into a meaningful external business. My 2026 base case target is $110 to $125, while my 2027 base case target is $130 to $155, with a potential bull case target of $170 to $200. So, is Intel stock a buy for 2026 and 2027? The answer depends on your risk tolerance. Intel is no longer simply a cheap semiconductor stock. It is a high-risk, high-reward turnaround story. At around $102.50, I believe the stock offers meaningful upside if management executes successfully, but investors should also be prepared for significant volatility. The three things that could determine Intel's future are simple: 18A execution, Foundry customer growth, and free cash flow improvement. If those three areas improve substantially, Intel could become one of the most interesting semiconductor turnaround stories of 2027.